Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. Here's your weekly technical analysis of New York and London sugar markets. I'll start with ice raw sugar in New York. The core of the bullish support here for the market during summer going into November had been the lower time of the December 2020 to April 2021 bullish shift pitchfork, currently at 1792. I've highlighted the whole pitchfork in blue so you can visualize the times more clearly, as they will become more important with regard to the last few weeks' actions. My only shortfall is that my camera image continues to partially obscure the lower time, but anyway, this lower time caused some very prominent rises most recently in late October and going into November, and is not actually effective at the moment. So the market gap higher and push up through all the moving averages, plus the significant February 2021 high at 1894, the congestion at 1964, and finally the middle time of the same big bullish shift pitchfork, currently at 2017. Prices earlier peaked mid-November at the congestion at 2047, last seen capping the market back in April. However, last week we saw a push higher peaking just over the November 2021 high at 2069 and over the middle time again of the same bullish shift pitchfork. Yet in this rise were the seeds of its own decline for that session, as the market formed a very large bearish harami. This week we closed back below the middle time, but there was no follow-through higher last Friday. Instead, we had an immediate countering bullish thrusting pattern last Friday, which pierced but did not close up over the middle time. 2 weeks ago, I was curious as to what all this very recent action might amount to. I saw back then that the whole late October to date action could be seen as a bullish halfway hesitation, in which case we might not only see a resumption of the move higher, but we could even have a possible bullish halfway hesitation with potential right off the top of my daily chart, way up in the 2190 area. Alternatively, I also saw that if the market moves up but fails once again at say the 2050 area, dropping then backwards, back downwards, well, the market can then form a double top with all the opportunities that might present. Back then it was a little too early for either of these ideas, thus I decided 2 weeks ago that I and we would have, and I quote, wait and see any of these develop, as I suspect the market has not yet made up its mind, end of quote. Well, 2 weeks on, and I'm still studying this market carefully, though I think the idea of a bullish incentive being the dominant force, well, it seems increasingly likely right now. I'm waiting to see if prices can stabilize over the middle time, rather than just keep piercing it. Europe white sugar in London. Changeovers. Changeovers produce some strange events here. Since mid-September, this market has been dominated by the one action, the changeover gap that happened back then. Well, I can say a lot of things about what happened beforehand, but that changeover gap here, seen on a continuous daily chart, is really big. There's been a number of attempts since, initially tepid in September but more active in October and November, to try and fill it. The latest attempt made some great strides in filling in the gap, but it ran short because of another changeover that ended up with an island top and another gap between 552.80 to 561.30, since filled in but still leaving the island top. After that, prices fell away on the daily continuous chart, below all the moving averages. But we also found that prices didn't like being down there either, with some interesting support from the 50% Fibonacci line of the July 2021 to September 2022 move at 522.80, 3 weeks ago. There has to be, honestly, I've left the whole situation a bit up in the air. The last 3 weeks have seen a move higher, slowly and with determination, such that last week prices managed to make a weekly key reversal up, barely closing over all the moving averages, but not as yet managing to punch up through the congestion and lesser Fibonacci line at 548.80. Punch up, but not yet close over it. The sideways action to a little higher seen since mid-November, has given way last week and again today to a move higher. The immediate overhead resistance is the February 2017 high at 565 even, which capped last week's rise, followed by let's be honest, dubious resistance from the neckline, currently at 570.30, of the August to December 2021 complex head and shoulders top. Beyond that, well, we have the high in mid-November at 581.40, and after that, well, we start filling in that September-based changeover gap, with really only the November 2016 high at 590 even in the way. This seems, and actually is in real life, an ambitious move, but it all depends on the February 2017 high. Now, to finish off, I've drawn a small late October to late November bullish shift pitchfork, more in speculating as to whether it would work or not. At the moment, the immediate overhead resistance is the middle time there, currently 558.70 of the bullish shift pitchfork, which is highlighted in dark blue. I'll be interested to see if this prospective nascent, shallowly bullish pitchfork, especially in the immediate future, the middle time, whether it will show the direction of the market. Watch this space to see. Sugar white premium spread. That's a long bit, this one. This continues to yet again be a colourful chart with many things going on all at the same time. I'd previously spoken about two big picture items seen here on this weekly chart. We have the recurring big old bullish Andrews pitchfork from 2019 to 2021, highlighted in blue for the market, currently in between the lower time below, currently 83 even, and the middle time above, currently 157.25. Though breached in the past, this is still showing the overall major bullish angle of attack. We also have an ascending expanding wedge pattern, highlighted in red trend lines, well above the market, that was formed since mid-April to late November, currently 149 even to right off the top of my weekly chart. To me it was and still is not the best looking of such wedge patterns, but it was also still there. It comes with all the possibilities such a pattern can evoke. A subpoint to this had been the monthly key reversal down we saw in September. Despite what's happened since, which seems sort of to justify this selection, please still take this monthly key reversal down with a huge pinch of salt, as the earlier monthly key reversal down we saw in July did not work out so well. Nevertheless, it was genuine at the time. The most recent activity has been the small reactionary move back up 4 weeks ago, after the prior week's huge counter-to-counter weekly key reversal down, which offset as it did by a country mile the previous week's immediate countering bullish engulfing pattern, which in its turn also, the week prior to that, had been a weekly bearish engulfing pattern, just and bear spike. Quite complex. In all this, the recent capping top had been the neckline of the big June 2021 to May 2022 reverse head and shoulders pattern, which I've highlighted in bright green, currently at 144.25. To bear in mind, just in case we see significant price rises. Interestingly, recent action justified part of my commentary made 6 weeks ago, and I quote, below the long moving average, which is currently 124.5, we have really nothing much until the late April to early May congestion, based around the lesser Fibonacci lines at 104.5 and 107.5. The core of this congestion is in the 102 to 107 zone. End of quote. I continued, and I quote again, so with all these actions and points, it is time to look at possible targets below for the break below the ascending expanding wedge pattern. Thus, a potential target X on the downside would be in the 102 even zone, just below the late April to early May congestion. End of quote. 5 weeks ago, prices dropped down to reach the primary target at 102 even. The action ended up quite a way below it due to overrunning. However, I was mindful back then and since that we were approaching the lower time below, currently 83 even, and again highlighted in dark blue. And that's of the big 2019 to 2021 bullish Andrews pitchfork, as well as the neckline of the February to September 2020 head and shoulders top, currently at 75.75, which is below the lower time now and highlighted in pink. I suspected last week this one might be important, hence the highlighting. In case you are interested, the secondary harder to reach target X1 for the expanding wedge pattern is way down in the 46.75 zone. This brings us to last week's action, which was a combined immediate countering outside week and bearish engulfing pattern, if only just on the latter. However, the first session of this week has not as yet shown any follow through lower, and instead made a more reactionary move back up. It crossed my mind that perhaps, just perhaps, the action since the middle of November might be building up to a possible bear flag or bearish halfway hesitation. It is very early yet to start thinking that. It's even too early. But I just wish to lodge that thought in your mind in case it turns out to be something. Thank you for listening. This weekly broadcast gives essential market patterns and consequences. Please be aware of the risk disclaimer posted with the broadcast. Copyright ZD Tofpik and ADM Investor Services International Limited. And here comes the final bit.